Hey everyone, welcome to today's video on registered retirement savings plans, also known as RRSP accounts. Now these are very popular accounts among Canadians and many individuals utilize these today. But do we know exactly what an RRSP account is, how it works, and what things we should be aware of? Well, I'm hoping this video can shed some light on that for you, whether you're new and starting to open up an account yourself or have an existing account already. So let's jump into things. What exactly is a registered retirement savings plan? Just like it says in the title, retirement savings plan, that's exactly what it is. It allows Canadians to save for retirement. The account itself, however, in terms of opening one, you must be a Canadian resident with a SIN number, must have earned income, and file taxes in Canada. There typically also isn't any age restrictions when it comes to opening up an account. However, most financial institutions will wait till you're the age of majority before opening an account for you. And finally, you can open one up with either a credit union, a bank, or any financial institution. Let's now look at how an RRSP account works. You can make contributions into this account, and to make your contributions count for the current tax year, you have the first 60 days of the following calendar year to do so. For an example, it's currently 2025, and this year's RRSP deadline to make contributions count for tax year 2024 would be March 3rd, 2025, meaning I have up until that date to make a contribution. If, however, I wait after March 3rd, 2025 to make that contribution, then that contribution is going to count for the 2025 tax year. Any contribution you make are generally tax deductible, and the benefit of that is if you have any tax owing, you might be able to reduce that amount, or if all things are great and you have no taxes owing, you may also be eligible for a tax refund. Once you've made that contribution into that RRSP, the money is going to grow tax deferred, and then when you withdraw it, it's going to be considered taxable income. And that is very important to remember and note. Sometimes this often gets overlooked as well, but again, withdrawals from an RRSP are considered taxable income. Let's now look at the contribution rules. Because we can't just contribute as much money as we want into this account, there are some guidelines and rules that we need to follow before doing so. In terms of contributions, we're allowed to contribute either 18% of our earned income, or as of 2024, a maximum of $31,560 into this account. To put that in an example, let's say I make $100,000 a year. 18% of that would be $18,000. And on the other hand, the maximum contribution for 2024 is $31,560. However, because $18,000 is the lesser amount of the two, $18,000 is what I'm actually allowed to contribute into my RRSP. But what happens if I don't make that contribution? Let's say I chose not to make a contribution this year and chose to leave it as is. That contribution room actually carries forward as well. And if you're curious to see exactly how much contribution room you have two options. You can call the CRA and they'll give you that information. Or the second one would be to log into your My CRA account and get that information which is available to you. And the My CRA is a great tool if you haven't utilized it already, because it allows you to, one, bypass the wait times when you're calling the CRA, but also gives you access to a lot of tax information at your disposal if you need right away. And finally, you have up until December 31st of the year in which you turn 71 to make a contribution into your registered retirement savings plan account. Did you also know that there are multiple RRSP accounts available as well? Let's look at that. So the first one, which is the most basic, would be your individual RRSP account, typically what you open for yourself. The other option is to open a spousal RRSP account. Now this account is typically used when there's a higher income earner who would like to make a contribution to the lower income earner's spouse. Let's look at this in an example. We have spouse A, who is the higher income earner, and we have spouse B, who has no income at all. Spouse A, as long as they have the contribution room, can make a contribution to spouse B's spousal RSP account. And when they do that, spouse A will receive the tax deduction, and spouse B will be the owner of that spousal RRSP account. So there are some advantages to this account, and if you're curious to see how that fits into your plan, you can always speak to your financial professional about it. Then lastly, we have the group RRSP. These are typically opened by your organization or employer. But what about investing the money? What exactly can I invest my money in when I've made that contribution? The good thing here is you do have a lot of investment options, and those range from ETFs, stocks, bonds, GICs, currencies, and even annuities. Let's now look at making a withdrawal from this account. You necessarily don't have to wait until retirement to pull money out of this account. You can do so earlier as well. However, any withdrawal you make again is going to be considered taxable income. And there are also some withholding tax rules that we need to be aware of as well. And those numbers are as follows. If you were to make a withdrawal under $5,000, there's going to be 10% withholding tax on that amount. If you make a withdrawal between $5,000 and $15,000, there's going to be 20% withholding tax. And then anything over $15,000 is going to be taxed at 30% withholding tax. And then whatever's left, that's going to be going into your income. To put that in an example, let's say I needed to do a withdrawal from my RRSP for $40,000. Based on the withholding tax rules, there's going to be a 30% tax applied to that $40,000, which means $12,000 is going to go in taxes. Then the $38,000, which I will receive, is going to go into my taxable income. So it's very important to be aware of these withholding tax rules and the tax implications when making any withdrawal from this account. Let's now jump into some important things we should be aware of when it comes to this account. The first one being overcontributions. And like we previously discussed, there are rules and guidelines in terms of how much we can contribute, but if you did accidentally overcontribute, the rules are as follows. The first $2,000 of overcontribution, there is no penalty. However, anything excess above that will be taxed at 1% per month. Let's say my contribution limit is $10,000. That's all I can contribute. However, I didn't know and accidentally contributed $15,000 into my RRSP. The first $2,000, there's no penalty on that. However, the $3,000 that's of excess over that $2,000 is going to be taxed at 1% per month. The second thing to note is if you have a company-sponsored registered pension plan or a deferred profit sharing plan, your contribution room will actually be affected as well and could be reduced. This is known as a pension adjustment. And with the group RRSPs through your organization, if you're contributing to that as well, that will impact your contribution room if you were to make a contribution to your personal account. Now, let's look at some unique features that the Registered Retirement Savings Plan offers. And those are a home buyer's plan withdrawal and the lifelong learning plan withdrawal. When it comes to the home buyer's plan, we can utilize this RRSP account to make a withdrawal and use that as a down payment on our first home. And that withdrawal acts as an interest-free loan, meaning I can take money out without paying any taxes. However, I will be required to put that money back in. Now, that doesn't start until 2 years after your withdrawal is made, and you have up until 15 years to put whatever money you took out back into your RRSP. And how much can you take out? Well, based on the April 2024 budget, you can take up to a maximum of $60,000 from your RRSP account. Let's now look at the lifelong learning plan. Similar to how the home buyer plan works, you can utilize your registered retirement savings plan if you chose to go to school full time. You can borrow up to $10,000 per year, but a maximum of $20,000 over the course of 4 years from your RRSP account. There are some eligibility requirements that need to be met first, and if you'd like to know what those are, you can speak to your financial professional about that. So to break this account down, let's look at some of the pros and let's look at some of the cons. Starting with the pros, the great thing about this account is that any contribution you make are typically tax deductible. Your investments within this account go tax deferred. 3, it can help supplement your retirement income. And 4, it can be part of your retirement income alongside your Canada Pension Plan and your Old Age Security, your OAS. Now let's talk about the cons. First and foremost is the taxes. Any withdrawal you make is going to be considered taxable income. The second is what happens to your RRSP when you pass away. If you have a qualified beneficiary, such as a common law partner or a spouse or a financially dependent grandchild or child, the money in your RRSP will roll over to that individual on a tax-deferred basis. But what if you were to pass away and had a non-qualified beneficiary listed on your RRSP account? And a non-qualified beneficiary includes your estate, a charity, a financially independent child or grandchild, and a non-related individual such as a friend. If that were to happen, your RRSP is going to be taxable. Let's look at that in an example. Let's say you've worked hard, you've accumulated quite a bit of RRSPs, and at the time of death, that account is valued at $500,000. So if we were to take scenario number 1 and we had a qualified beneficiary listed on our account, that $500,000 would roll over to that individual on a tax-deferred basis. Scenario number 2, that same $500,000 at the time of death going to a non-qualified beneficiary is actually going to be taxed as income. So here in Alberta, that's 48% tax that's going to be applied on the $500,000. When we calculate all that up, approximately $200,000 is going to go to the government in taxes. And $300,000 is going to be what's left over to give to my non-qualified beneficiaries. Now this is very important and sometimes this can get overlooked. So if you consider your own financial plan, if you have a goal or a desire to leave part of your wealth to the next generation, it's very important that you consider whether they're qualified beneficiaries or non-qualified beneficiaries and see how that impacts you and your wealth and plan. Well, if you stuck around to the end of this video, I do appreciate you and I appreciate you taking the time to watch this. I hope this video was able to give you some insight into some of the things we should be aware of when it comes to these accounts. And finally, I do kindly ask that you hit the subscribe and like button below, and I hope to make more educational videos like this in the future for you. Thanks again, and we'll see you on the next one.